So good evening, everyone. I'm Satchit Sawant. I'm part of DCM origination team at Tipsons, and thank you all for joining this webinar today, which has been arranged by the fixedincome.com portal. This is India's leading online debt platform, which is registered with SEBI. And we welcome everyone for today's webinar discussion with Mr. A.M. Karthik. He's the Senior Vice President and Co-Group Head at the Financial Sector Ratings team at ICRA. And ICRA, as we all know, is India's leading credit rating agency. So, welcome, Karthik, sir. And just to give a brief introduction on Karthik, sir, he joined ICRA 15 years ago as part of the corporate ratings team in 2008. And he was in the corporate ratings team till from 2008 to 2012 with a focus on steel, engineering, and auto sector ratings. He then moved to the financial sector ratings team in 2012 and is now leading a team of 15 analysts focused on the ratings of NBFCs, which is non-banking financial companies. And apart from ratings, he's also responsible for the NBFC related research publications which ICRA publishes. Till 2019, Karthik was also assisting the analytical team at ICRA Lanka for their financial sector ratings. In 2022-23, Karthik sir has also spent 6 months as part of the secondment program between ICRA and Moody's with the analytical team at Moody's Singapore. Prior to ICRA, he has worked with SR Steel for 3 years as well, and he has completed his MBA from BIM Trichy and BE Mechanical degree from NIT Surat. So welcome, Karthik sir. We would like you to take us through the ICRA's rating methodology of assessing NBFCs, and then maybe we can take up the ICRA's sectoral outlook on the NBFC sector across the various asset classes. And subsequently, we can also cover the recent RBI directions on increasing the risk weights for NBFCs and banks and their implications. Over to you, sir.
Sure. Thank you, Satchit. Thanks for a detailed intro and many thanks for having me for this webinar.
Yes.
We have planned this for about a 30-45 minute kind of session where we could make it as much interactive as possible. We have four broad points to discuss today. One is the NBFC rating methodology of ICRA, our rating scale and the rating universe in the financial sector space, the key trends that we see in the NBFC sector, and the recent guideline and the regulation related impact on the sector as a whole. So let me start with the methodology, which we typically apply for rating the NBFCs at ICRA. So this is a busy slide. I shall cover the business risk and the financial risk component in detail in subsequent slide. But to give a broader gist, we look at both quantitative and qualitative aspects while assessing an entity. Qualitative aspects would cover, governance, control, underwriting processes, their relative positioning, quality of disclosure, so on and so forth. Right. So the first three components, which is essentially the business risk, governance, and financial risk analysis, helps us in arriving at a specific level of rating for an entity. And that rating could get influenced on account of group-related aspects. If there is a stronger group, if it's part of a stronger group, the rating would get benefited on account of it. Similarly, if there are group-related concerns, the rating could get affected or capped at a specific level. So it works both ways. So let's get on to the key factors: business risk and financial risk. Governance is anyways, it's a very, very qualitative assessment of the overall structure, etc. So in the business risk analysis, we do look at factors like size, product riskiness, diversification, in terms of product and in terms of geography. track record of entity, and the pace of growth. I think the first 4 points are fairly understandable. I'll touch upon the fifth point, which is where I feel there could be some emphasis. A high growth is typically not seen very favorably in all instances, because the high growth could possibly entail risks which are not possibly visible at this point in time and may pan out on a later date. The high growth could have impact in terms of what kind of underwriting has gone into the business, and what is the level of portfolio seasoning, because some of the performances based on which the growth is being driven might actually result on a later date. So a high growth is viewed more cautiously. It's not a significant negative, but it's viewed more cautiously, and we gather a higher quantum of data to analyze the and try to reduce the impact of the growth while assessing some of the parameters, essentially asset quality, so on and so forth. Similarly, slower growth also is a fact of monitorable, because it does give us a sense that the entity is not competitive enough to at least grow at a level where the industry is growing. So having looked at all these 4-5 parameters, these are slightly broader numbers. We can get into details if you have any other specific questions. But after looking at business risk profile, we also consider a top-up which is on the component of operating environment. We do have a very stable outlook for the NBFC sector at this point in time, barring infra where we have a positive outlook. Again, stemming from the fact that their asset quality numbers have seen substantial improvement, earnings have improved substantially, and capital profile, which was a bit stressed a few years back, has also normalized significantly. So infra is a space where we do have a positive outlook, but we do have a stable outlook on all other segments, including microfinance, within the NBFC space. So let's understand what drives this operating environment aspect for us. So it's a combination of both entity specific and the sector assessment when we look at operating environment as such. So it could be something from an NBFC point of view, the sector that they are operating in, what is the demand dynamic, what is the growth dynamics, the liability part, how it is getting managed, the competitive positioning for an NBFC to operate in a specific segment or space, and of course the regulatory development, which has been the talking point at least for the current year so far. So all these rolls on to bring out a operating environment score for us, which can have an impact on the business or the financial risk profile of the entity. So getting on to the financial risk assessment, where we can start off with asset quality. I think this is one of the most primary aspect within the financial risk assessment for us. We do look at headline numbers like DPD, trends, absolute DPDs, or NPAs, write-offs, provisioning, solvency, so on and so forth. But apart from looking at absolute numbers, we need to also delve into trends which are possibly driving these numbers, the underlying factors, the undercurrents which can have an impact on asset quality going forward. Something like concentration risk, very, very large amount of exposures to group entities, loans which are into moratorium and possibly are not a clear reflection of what kind of risk that these loans will ultimately throw up on a later date. And things like headline numbers in terms of how is the trend of secured, unsecured book. Are there any specific stream of assets within the portfolio which can affect asset quality? And more importantly, in terms of the underwriting policy itself. So a portfolio cut analysis gives us that assessment on where the entity is moving in terms of its incremental exposures vis-a-vis what it has taken in the past, and whether these movement can affect asset quality on a future date. So to give an example, if the LTV trends or on the rise for an entity, will possibly indicate that the company is taking higher exposures vis-a-vis the collateral against which the loan is being lent. And is it being done with adequate underwriting guidelines or guardrails in place, or is it being done from a business proposition alone? And again, seasoning is a factor which goes into for a significant analysis for us. We don't look at only headline numbers from an NPA point of view. We top it up with write-offs to see whether and typically the write-offs go up in a stress situation. So one should expect the impact of this on the overall risk profile of an entity. So asset quality is a significant primary focus for us, and we try to see as much details as possible. Static analysis is something that we do for entities which are growing very fast to assess what kind of asset quality trail is it leaving of the disbursement or the loans which have been given out in the past. So it brings out a lot of insights, to look at it from a going forward point of view, and helps us in model our projections around these numbers and make scenario analysis on asset quality and the possible impact on capital and earnings of an entity.
Yes. And Karthik sir, just if you could give us a little more detail on how rating agencies look at hard delinquency buckets and soft delinquency buckets, and how it varies for different asset classes. Like for a secured asset class, it could be a little more stringent, or whether it is more stringent for an unsecured asset class.
Sure. On the while we look at hard delinquencies as a base, the trend in the soft delinquencies is something that is of importance to us. And one should realize that NBFCs over the years have seen a transition in the reporting of NPAs or gross stage 3 for that matter. Because unlike banks where the requirement was always on a 90-day overdue basis, NBFCs at some point in time, not way back, maybe about 10 years back or so, they had a 180-day recognition of NPA. Ind AS was not applicable then, but the NPA was recognized at 180-day, and entities moved gradually from that 180-day regulation to a 90-day reporting requirement over a 4-5 year period. And we didn't have too much of track record of that, because there were events subsequent to that which kept moving those 90 plus DPDs up. So the softer bucket delinquency, we look at more from a trend analysis point of view. Of course, if the number is too high on the softer bucket delinquencies, which reduce substantially on the subsequent buckets, we do get into details to understand how that is being done. Secondly, on your question on how do we assess secured and unsecured business, unsecured business the typical trend is that the loans do have a high propensity to get written off vis-a-vis a secured loan book. So in those cases, the write-off will give you a very, very clear indication of what is the actual stress that one is seeing in the book vis-a-vis a secured loan book. The talking point now is essentially on what do one see in the fintech space and the shorter tenor book, where the churn itself is so high. Right? So some of the conventional ways of assessment, which is looking at the outstanding portfolio and comparing with the overdues, will make less sense. What we try to do in those instances, because the business model in these cases are devised from a transactional point of view, because these are very short-term loans. The loans get churned out quite fast, and the outstanding portfolio might be a residual component of the complete flow of loans which has gone through over the period. So to give an example, if a loan is for a 3-month period, at the end of the year, the loan book that you see would have churned at least 3 times, if not 4. Right? So there is a good propensity to look at numbers where in some cases the number would look exaggerated, because what is sticky and which is remaining as an NPA is a resultant of a book which has flown through, and what is resulting in a final AUM on an year-end basis is not clearly a reflection of what has been the flow. So in those cases, we do also look at the ratio in relation to disbursement. We look at static data more closely to assess what is the loss at a cohort level, because some of these businesses on a short-term loan basis are underwritten with the expectation of a loss, and the loss is adequately factored in terms of pricing, whether it is a processing fee or the yield. So it makes sense to look at asset quality numbers differently for different asset segments, as much as possible, and try to be more realistic to what the business model is getting devised, based on which it is getting devised.
Okay, thank you.
So hope I have answered your question.
Yes, definitely.
So on the liquidity front, this is a challenge, of course. The ALM that gets reported from a structural liquidity point of view is not very uniform across players. There are various adjustments done, which we will have to do to make it comparable. In some cases, there are income and expenses which gets factored in as part of the ALM. In some cases, the entities do bring out a behavioral trend in terms of assessing inflows or prepayments and so on and so forth, while others go on and report it on a contractual maturity basis. So in many cases, the asset liability which is publicly available may not be comparable and would need some adjustments to be done to make it comparable. So we try and do those for our assessment. But apart from looking at ALM, the important aspect from a NBFC perspective is the refinancing ability, the funding diversity, and their track record of raising monies in the past, under various situations. And what is the relative cost of funds, which can give us an indication of their ability to raise money, and willingness of the borrowers to look at this entity on a favorable basis. So cost of funds gives out a very clear indication of how the lenders view it, and what is the pricing flexibility that the entity has on its own. Some of the things which we are looking at more closely is the share of short-term borrowing. Of course, it has come down substantially in the last 5 years vis-a-vis what we used to have pre-2018. But the things are that one would see that going up with the cost of funds remaining at an elevated level for a prolonged time. So one would see short-term borrowings going forward increase as a share of the overall debt, and that would remain a monitorable for us. We also look at covenants which go into some of these loans, and we test it in relation to their operating parameters at this point in time. So some of our rating triggers which we put out are also also factor in what kind of covenants are put into place from a lender perspective, and what is the impact of this covenant on the entity's borrowing and on the liquidity. So if a covenant is resulting in if a covenant breach, let's say in an instant, results in an increase in the cost of funds, that is deemed less severe than a covenant which actually results in an accelerated payment. While one has not seen much instance directly related to covenant so far, but one would be looking at prepayments, pre-closures happening in entities which are possibly getting stressed, etc. So covenant assessment becomes important. This about drawing power, what kind of security that an entity is extending, and whether the security is good enough going forward to secure incremental borrowings, and what kind of backup limits are being maintained on a consistent basis are critical factors which we look at it from a liquidity perspective. On the capital side, yeah, there are regulatory requirements which are there. Leverage is looked, in relation to the regulatory requirement and the buffers that one is maintaining over and above the regulatory requirement. But it also is a factor that is it in relation to the risk? Because at this point in time, apart from the recent regulation that one has seen, there's not much of a differentiation within the broader NBFC sector. There are some benefits which are extended from a housing finance point of view. If the loans are meeting criteria which is applicable for a home loan component, the vast majority of the other loans within the NBFC space are risk weighted at a common basis. So our capital estimates, we do have different measures from a capital requirement point of view, depending upon the risk assessment of that specific asset segment. Give an example, if the loan is unsecured in nature, obviously as a rating agency, one would be more comfortable with a lower leverage vis-a-vis a secured book which has seen cycles and where the credit losses are much lower, where one would be comfortable with a slightly higher leverage in relation to a unsecured loan book where the write-offs or the credit losses are higher. So having said that, we do look at the capital profile as on date, and also look at it on a forward-looking basis on what is the management philosophy around capital and leverage. Because the rating is for a longer tenor. The investors take a call on the rating and take a longer term exposure. So to ensure that our capital philosophy and the comfort levels are consistent for a specific rating category, and it's consistent with the overall philosophy that the management is looking at it from a leverage point of view. We look at both to factor in and arrive at the scores from a capital adequacy point of view. We also assess,
Yes, go ahead, sir.
The same, we also look at the capital requirement. If the management gives the guidance of a specific level of leverage and the entity is operating at the same level of leverage at present, and if the growth is going to be higher than what the business is actually generating from its internal models or from its own income, one would need capital to supplement for that growth. So we do look at forward-looking capital requirement. If the capital requirement is substantially larger than the current position in relation to the current net worth, that is a seen more conservatively and monitorable vis-a-vis where the capital requirement is not much and entity is on a much more steady state kind of a growth, and where the internal generation is good enough vis-a-vis the growth requirements. So that's on the capital side.
Yeah. So Karthik sir, there was a related question on the chat in the question and answer. One of them is on the same point, so I thought I'll just point it out. How does the standard or benchmark of the leverage ratios differ across the various sectors of NBFC industry? So do you want to touch upon on that?
So as I said, we can give out some of these numbers that we monitor are internal, but you could get a fair sense of it looking at our rating triggers. Capital is a typical rating trigger for us, and it will be there across entities. While we don't have a stated policy on capital across asset segment, but you could get a fair sense of our views for a specific sector looking at our triggers.
Thank you, sir.
Finally, on the earnings part, right? So earnings is a derivative of all the other aspects. Essentially, what is the segment that one is operating in, what is the leverage that one is working with, cost of funds, liquidity, everything. This number is one composite number which could give a sense of where the entity is, what the entity is operating in it at, and what could be the trend going forward. So we look at the overall ROA tree, as such for us. While the final number on ROMA is a is a monitorable, but ROMA is also a composite factor of all the other factors. Leverage plays an important role, right? So if the leverage is low, two entities operating in the same segment, same amount of yield, cost of funds, operating efficiencies, credit cost, etc., the leverage will play a difference because a lower levered entity will have a better ROMA vis-a-vis a higher levered entity. So in those situations, the steady state leverage is looked into and the profitability incrementally is assessed. That's where I think that there is some level of difference in terms of assessment comes in. While as a equity investor, one looks at ROE, which is directly proportional to the leverage. You have higher leverage, you have higher ROE, with ROA to an extent coming down. But from a rating agency point of view, the capital buffers are seen more prudently from a requirement point of view, from a risk assessment perspective. The profitability is looked across cycles. One also looks at diversity of income in terms of what are the other income that can supplement the impact, if there are any, from a interest income point of view as far as earnings are concerned. So this essentially summarizes some of the points that we have covered, which we just want to reiterate some aspect. Exposure to riskier segment, riskier structures, which involves bulk exposures, concentrated exposures, exposures which are not backed by adequate cash collateral, significant deviations in credit policy. As I said, getting into asset segments which are new, or getting into borrower segments where one has not operated in the past, or getting into weaker borrower segments. They are some monitorable from an asset quality point of view, on the asset side assessment point of us. On the liability side, again, most of these points we have discussed, but just like to reiterate, one or two aspects, which is on the funds which one get from a securitization point of view, how well it is managed, what kind of contingent liabilities does one carry, and what are the impact of those contingent liabilities on the liquidity profile of the entity. These gets looked into more closely. And apart from this, aspects like restrictive covenants, which can affect incremental loans. Let's say a borrower is in breach of certain covenants with a lender. There is a chance that incremental credit from the same borrower could go down. So till the covenant is corrected for the existing loans, etc. Increase in short-term debt, ALM mismatches are something that is something that will be a monitorable going forward. We would feel that the short-term debt across players would start inching up, because short-term debt is viewed as a lever to keep the cost of funds under control. So we would see short-term debt going up, and expectation is that the rates will moderate in the near term. So entities would want to tide over the current period and not lock in long-term rates. So there is a propensity to go into short-term rates and floating rates, which will be available from banks, etc., vis-a-vis a fixed rate loan, which capital markets typically offers. So these things will remain monitorable, at least for the next few quarters, before things starts improving on the liquidity. So a typical question that comes to us is, how do one assess a smaller entity vis-a-vis a larger player? The smaller entities typically have a good financial risk profile if they have gone through the initial teething issues where operating level efficiencies have kicked in, but credit cost aspects have not fully panned out. So there is a good amount of a period between actual steady state achievement and achievement of operating efficiency and stuff. That's when the numbers will look too good for many of these mid-sized, small-sized entities, and financially numbers will look too good. But some of the aspects, which go into our assessment is also business related. So by virtue of their own size and the segment that they operate in, they will not have they will have restrictions in terms of geographical diversity or product diversity. Because of the virtue of growth, portfolio seasoning would be low, and the borrower base would be different. They will not be catering to a prime segment. Focus would be on self-employed, average borrower profile. Senior management would be on a scale-up mode because the scales have not fully been achieved. Some of the systems and controls may not have been fully tested and would be evolving because the scale itself has gone up. If I have to give an example, an entity in the early phase would have a very, very controlled, centralized model of underwriting and risk assessment and controls, while it would get a bit cascaded down once the scale increases, because at a larger scale it's difficult to operate with the same amount of efficiency when everything is centralized. So some of these operational related risk, asset quality related risk, would pan out on a later date, and that's what we try and inculcate for smaller entities, and that's why our model by design would have slightly higher weight from a business risk proposition vis-a-vis the financial risk parameters.
Yes. And sir, how important would be the weights, or how important is the equity infusion and the track record of the promoters or the parent company when you assess for ratings?
On the equity infusion, the event itself is a credit positive, because one, it gives a slightly forward-looking view in terms of the entity to scale up in line with their growth plans. Secondly, it also gives that additional buffer in case of any shortfall or credit risk that may devolve on the entity going forward. But at a very large scale, right? So where capital becomes a requirement per se, and it's let's say the capital is required every 2 years, and the quantum of capital that has come in gives a visibility where possibly the leverage improves for a short-term period, but subsequently goes back to the same level, and you would need further capital to bring it down. One has to view it slightly on a different lens. So a capital which gives a slightly longer visibility in terms of risk profile and assessment is viewed more favorably than the capital where you need capital more frequently just from a growth requirement point of view, meeting your own internal capital assessment point of view, or for meeting regulatory capital requirements. So capital event per se is positive, but the impact of it on the credit rating, on the credit risk profile, depends upon what kind of visibility one can get out of that capital. On the I missed your second question.
The promoters of the company or the parent company, the kind of support that you expect from them, how important does that factor in the ratings as well?
So on the parent entity, if it is a rated entity, I mean our model itself is to arrive at a rating which typically gets notched up or down depending upon the group related factors or the parent related factors. So the movement could be as close or equal to the parent, or maybe a few notches down depending upon the factors. There are 4 factors which drive the extent of notching or the extent of mapping to the parent itself. One is the level of business linkages, the strategic importance, reputation sensitivity. Reputation sensitivity is fairly straightforward in terms of what is the level. I mean, whether they have the same kind of branding, name, etc. Strategic importance is how closely is the subsidiary's business risk profile or the requirement mapped to the parent, and whether from a group point of view is it a strategic fit, or is it not. I mean, we have our own internal guidelines in terms of assessing the strategic importance. And finally, on the form of support. So if there is a very, very committed form of support or if there is a more tangible or an explicit form of support, it gets higher benefit. Vis-a-vis no clear articulation of a support, gets possibly the lower risk. So we have a model again around it. It's around this is also publicly available in on our website. So there are these four factors which drive it. So the rating could be equal to the parent or be lower depending upon these four factors. Specifically on the promoter itself, if it's an individual, not much of benefit is given. Similarly, from a private equity point of view, also, if it is private equity, while there is, capital support which may come in on the initial years and possibly near-term benefit, there's no uplift that is possible from the model perspective as far as these two components are concerned, which is individual or private equity. But that again depends upon in some cases sizable capital infusion do drive support or improvement in risk profile overall, do support the ratings overall.
Okay. That's really insightful.
So we'll move on to the next section. I'll just keep it brief, considering the want of time. So this is a rating scale. So anything beyond triple B is an investment grade on a long-term basis. Triple B minus. Similarly, anything above A3 is an investment grade. To touch upon, I think the general ratings do have a outlook tag attached to it. So all ratings above a double B minus category, is will have an outlook. Below B minus, we don't have an outlook. It is absolute rating only. Outlook essentially is a direction of where the rating would be in the near to medium term. While in other cases, we do have rating watches, which are the expected direction. Again, I mean, very closely. If you look at the difference, it is very subtle. In the rating outlook, there is a bit of certainty in terms of things that have happened, and the rating is directionally moving in that way. In rating watch, it is somewhat short term in nature. This kind of action is taken when an event pans out, and for the event to fully fructify into a credit implication, there are certain steps or events which are still pending to take place. Let's say an approval from a regulator or a lender approval, so on and so forth, which cannot be ascertained as a fact today. In those instances, watches do come into picture. So again, you have three types of watches: positive, negative, and developing. So developing watch comes into play when the uncertainty is such one is not able to clearly imply whether the rating direction post that event, if that pans out, it will be positive or negative. So to summarize, a rating watch is for a shorter term frame, while a rating outlook can be there for a period of about 6 to 24 months. Again, an outlook where the event has taken shape, which will lead to a rating action. Maybe it is put on positive outlook because we feel the upward movement could happen over a period and not immediately. In those cases, outlook is put. And watch is essentially event driven, and for a shorter term. Again, some of the events can also result in an outlook change, but that event is of something where you have the complete information of that event, and that event has actually panned out. So in those cases, one do see outlook rather than in events where there is some level of uncertainty or factors to be panning out before one could see that the rating moving. So in those cases, watches are. So to give a gist of what we have as a rating, we have rating on about 300 entities on the financial sector space as a whole. About 122 NBFCs are rated, and close to about 34 HFCs and close to about 19 MFIs rated. Most of the AAAs that you see here on the overall financial sector space are sovereign backed or backed by essentially sovereign backed, and a good amount of other AAAs are also backed by larger groups or banks for that matter. Moving on, this is a breakup of our rated universe within NBFCs, HFCs, and MFIs. Median rating for NBFCs, excluding MFIs, is a AA minus, AA for HFCs, and A minus for MFIs. So lastly, on our rating actions that we see, we have seen a substantial amount of upgrades vis-a-vis downgrades in the last two fiscals which have closed. And even in the current financial year, we are seeing upgrades substantially outpacing the downgrades. Essentially, I mean, things have been quite strong. Entities have come out of COVID well. Asset quality impact has been much lower than previously anticipated. Profits have come back to what it was previously. Capital profile remains strong. So a very, very comfortable position from a sector overall point of view. So I'll cover the key trends very quickly. So we look at NBFC overall, if I have to break it up, it's into 5 broad components. There's NBFC retail, NBFC wholesale. Wholesale are corporate loans and other loans which are larger ticket. Retail is everything which is not wholesale, essentially vehicle, MFIs, LAP loans, unsecured loans, so on and so forth. HFC, again, the component is broken down between retail and wholesale. Retail would have LAP and home loans. Wholesale would be largely construction finance. And NBFC infra, which is again driven by the public sector entities within the space. So the overall AUM, this number is again excluding HDFC for all past periods, March 23 and before, was about 40 lakh crore. We expect the overall sector to touch, cross 50 lakh crore in the next, by FY 2025. Growth will moderate. FY 2023 was an extraordinary year, coming out of a lower base in the past 3 years. And it was firing on all cylinders, essentially from a retail NBFC point of view. We will cover about more on this in the next 2-3 slides. So this is our breakup of the overall retail space, NBFC plus HFC. The AUM was close to about 22 lakh crore. We expect it to touch close to about 28 lakh crore by end of FY 25. Growth was quite substantial. If you could see that retail NBFC's AUM growth was almost close to about 22%, last year, touching near all-time highs, which was seen in FY 17-18. Numbers will pan down going forward. Last year was a growth which was driven by unsecured lending, where the AUM growth was close to about 50%, if I have to look at it that way, for the overall unsecured piece. The number would trend down going forward, which with other larger segments like vehicle, LAP, SME, etc., will pull down the growth going forward. But this is a healthy level of growth. I mean, one is not, as a rating agency, we are not looking at it as a deceleration in growth. One is looking at it as a healthy growth, which will keep the overall sector's health under control. That's how we see it. From an exposure point of view, see how the unsecured piece has panned out, which is the top 3 segments. We would see some stabilization of the same going forward, FY 24, FY 25. The expansion that one saw in between 21 and 23, that is what I think has resulted in some of the actions that one is seeing from a regulatory point of view also, in terms of the fast growth which one is seeing in the unsecured space. Asset quality for both NBFCs and HFCs have improved substantially. NBFC numbers are presently trending even below pre-COVID levels. HFCs are just about pre-COVID levels. One, with the fact that HFC is a secured book. So the write-offs and loan regularizations are taking a lot of time, while NBFC can write off a lot. So the write-offs for NBFCs vis-a-vis HFCs could be much higher. HFCs do not write off much, very low write-offs for them. While NBFCs could, the last 2-3 years have seen a 2 to 3% write-off. So if one would gross that up, then the numbers would trend slightly above pre-COVID levels. But what you see on a DPD basis or a gross stage 3 basis is a number that is much below pre-COVID levels for NBFC and near pre-COVID levels for HFCs. Capital profile, very stable. Things have improved in the last few quarters or years, in fact, because of the slower growth. Capital profile has, with the growth possibly becoming more reasonable going forward, one would expect that the capital profile will remain intact. We are not expecting significant capital raise, but of course some entities will do raise capital in view of the recent regulation. The entities, especially in the unsecured space, are having a high amount of unsecured lending in their book. Profitability will remain range bound this year. We expect some pressure next year. This will be the case for both NBFCs and housing finance companies. To give a broader outlook, the CAGR from a retail NBFC point of view will be 17 to 19 and 12 to 14 for HFCs. Some upsides could be seen for HFCs depending upon how some of the large entities do. Gross stage 3 is something that will be a monitor. This year would be a good year. We would see some improvement, while weakening would start kicking in the next year when growth slows down, seasoning catches up, and of course, asset quality related pressure. We have hit a low, so difficult to operate at a low for a long period. So impact would be visible. The extent, I think it's too early to say what would be the impact. We would come out with those commentaries maybe in a quarter or so on our expectation on asset quality. Funding would be a key differentiator. Up to a 5 lakh crore of incremental funding would be required for the overall NBFC space. Essentially driven by the fact that these would be incremental funding required over and above the revolvement of the existing lines which are getting mature. So this will be required from a growth point of view, to put it simply. Profitability this year would be range bound. Next year, one would see pressures starting to pan out completely. Again, stemming to an extent from the asset quality related pressures. Capital by and large should remain adequate. So the last section, of course, on the RBI regulation and the impact. So the impact is on the capital profile of NBFCs, where risk weights will go up for the consumer credit, which the regulator have classified, where the risk weights will go up. And the bank credit to NBFC, where the risk weights for banks extending loans to NBFCs which are not classified as priority sector loans from a bank credit point of view, that goes up. So the impact analysis for that is what being shown in the two-way table on the left hand side. The impact of this could be a factor of the leverage at which the entity is operating at this point in time, and the share of the impacted consumer credit, which is there on the books. So essentially, if the entity's leverage is 2x, then one is looking at the impact on tier 1 could be as high as 7%, because the base itself is so high. So at a 2x, kind of a leverage, one is essentially looking at a 33-34% kind of tier 1 capital, and that 34% will possibly come down to 25% or so, 26% or so. Similarly, if the leverage is 1, then the tier 1 is close to about 50%, then the 50 becomes 40% at 100% kind of a consumer credit exposure. So the impact will keep coming down as the leverage goes up, which is what one is trying to say. So it's not a direct impact. So some of the entities, let's say in the fintech space, where the leverage is at present low, the impact on the tier 1 which was reported in September and which possibly could get reported in December on account of this new regulation, one would see a larger dip, but it will still be much higher from a regulatory requirement point of view. So the capital profile is fairly comfortable. The impact of this regulation could be absorbed without much capital raise. Of course, some entity which wants to keep a much higher buffer than the regulatory capital requirement, and from a risk assessment point of view, will raise capital going forward. Lastly, our expectation is that on account of the higher risk weight for the bank loans to NBFC, the impact would be about 30 to 50 basis point for NBFCs, depending upon where they operate. The impact would be more pronounced for mid and small scale entities, but we do factor in that some of these entities do have a good pricing ability to pass on some of these rates going forward. Focus incrementally could rely more on securitization, co-lending kind of a structure. But the overall impact of this, one needs to assess on the competitive intensity. When the cost of funds for the NBFCs are going up, it's not getting affected for the if one were to compare it with banks. So essentially, a large NBFC operating in a segment where a bank operates, the competition goes up for the NBFC. Similarly, a mid-sized NBFC operating in a segment where a large-sized NBFC or a bank operates, the competition goes up substantially in relation to the bank, and higher in relation to a larger NBFC. So overall, the competitive pressure for the NBFC sector as a space will go up. This would push up some entities to move to a segment where the yields are higher, and that again will pull into the impact on credit cost and asset quality numbers going forward. So all these are the factors which is also driving our view that FY25 one would see asset quality related pressures. The extent of that is too early to assess. One would see how these things pan out and what would be the impact of those on those entities going forward. So I think this was the last slide. I think that's the end of the presentation. So any questions?
Thank you so much. I think there are quite a few questions in the Q&A round. Maybe we will take it up one by one. I think if you look at the slide which is on the presentation right away, I think you mentioned like cost of funds could go up by 30 to 50 bips depending on the leverage. So I think one of the related question is, do the NIMs for NBFCs also be impacted post RBI circular on risk weights? And also one other question is, how do these NBFCs which rely on bank funding prominently, how do they shift their source of funding to other sources? So would they also look at more of capital market instruments apart from securitization? What is your take on that?
Firstly, on the NIM question, NIM compression would be there. It's more academic in terms of assessment, but one do also have to understand that there is a good amount of pricing pressure which NBFCs command for the segments that they operate in. There is some pricing flexibility which we have seen in the past when the rates have gone up. NIMs do come down temporarily, but entities realign their portfolio. So I'll go back to the same point that I made. So entities get into a segment where the yields are higher. So to give an example, so if an entity is operating in a new vehicle segment, the used vehicle share could go up, which could balance the NIM and support profitability. But there will be a short-term period because most of these NBFCs which offer fixed rate loans, when the cost go up, the asset runs down at a slower pace vis-a-vis the cost goes up, because the cost goes up on the incremental loans and the loans which get repriced from a bank point of view, which are MCLR linked and so on and so forth. There will be a temporary period where one would see NIM compression, but the pricing flexibility that NBFCs offer will, I think, normalize that impact over a longer period. So that is one. On the
Source of funds. Source of funds shifting from banks to other sources.
So I think the regulation that has been brought in is with the idea of diversifying the funding profile, and that would be the key going forward. The question is on who are the other investors into the NCDs. If you look at the NCD investment profile, the major investors are banks, insurance companies, mutual funds to some extent, and corporates. So these are the four broad categories. So banks are anyways directly or indirectly are taking exposure apart from what they are taking as part of their bank loans itself. So the question is how many new investors can come into the capital market space to support this incremental flow. So if a bank is internally assessing their exposure from an NBFC point of view, one can look at it at a composite level. It's a bank loan exposure which is about 43%, as you see. A very high amount of debentures also get subscribed by banks. Even if I were to apply a systemic level average, close to about 30% of NCDs, if it is getting subscribed by banks, close to about 10% incrementally over and above this 43% that you see is with the banks. This apart, securitization, which is about 8% of the NBFC funding profile, is largely from banks. So give or take, you're looking at close to about a 60% of the overall funding which is coming from the banking sector anyways. I'm discounting some of the CPs because CPs also is a smaller component, but that too also comes, some amount of that comes from the banks. So I think incrementally one would see movement to capital market, but the question would be on capital markets, who are the new investors who can come in on the capital markets to give that diversity. So securitization is something that's an easy avenue. We are also seeing entities tapping retail issuances. So that's the way forward, where you have a catchment of retail investors who want to put in money, entities with a very high granular geographical presence can leverage on this retail investor base and retail presence and look into NCD issuances via the retail route. ECBs, etc., depending upon how it's been a bit slow in the recent past on account of uncertainties, etc. But I think things could loosen out with what is happening macro and what we saw yesterday, FOMC guidance, etc. So there are avenues. Capital markets is one, but we'll have to see who participates more in the capital markets going forward. So I think some of the participation from mutual funds have been a bit slow in the recent past, post 18-19.
Okay. So one of the questions was, how do the risk weights differ across NBFC sectors? Maybe I think the question is regarding this recent RBI requirement as to maybe which are the different asset classes which are impacted and which of them have been excluded.
So on the risk weights, the RBI has brought in for the composite consumer credit. They have excluded some segments, microfinance and home loans, vehicle finance, education loans, if I remember right. Everything else which is under the consumer credit component can get affected. The understanding that we are carrying at this point in time is that even some of the loan against secured loans, which is a loan against property, etc., as long as it is given for a consumption purpose, should entail higher risk weight. The question could be also on how do you treat the the top up loans on the vehicle finance space. So the regulation that came out also talked about the assessment of the top up loans given on vehicle loans to be looked at as an unsecured loan. But while conservatively one should say that this is classified as unsecured loan, so risk weight of higher risk weight should apply. But I think a clarity would help in terms of because these are not loans for consumption; these are typically for business purposes. Let's say from an insurance renewal or asset related servicing, etc., etc. So some clarity would help, but by and large, if one were to go by the definition of or the premise under which it is coming, is that the security is not of concern. The end use is to be looked into. and the end use can define higher risk weights on it. So consumption based loan with a, even if it is secured, could carry higher risk weight. That's our assessment, but I think clarity on this would help. Uh, it's being interpreted both ways by
Yes.
by by the by the participants. I mean, the clarity has been sought at various levels, but it would help. I mean, broadly, I think conservatively people are looking at it this way: that unsecured loans, top-up loans on vehicle, higher risk weight. A loan which is for consumption purpose, even if it is secured, higher risk weight. So that's a conservative assessment.
So, Karthik, sir, we have actually short up of time, but should we take up a couple more questions? There are a few in the pipeline.
Sure.
Yeah. So, one of them is any concern of ICRA on specific sectors of NBFC such as fintech or microfinance or unsecured asset classes?
So sector, I mean, the concern on unsecured sector is there, but I think from a risk profile point of view, most of these entities are fairly well capitalized. Some of them were on the path of profitability, and some of that would be a function of how the growth pans out. Now with this new regulation, if the growth slows, then the path to profitability also gets delayed to an extent. Right? So that's a monitorable for us on this space. Microfinance, I think there is a lot of commentary from the regulator in terms of how they are seeing it, and their views on profitability of some of these entities in the microfinance space. So it's too early to say, but I think that's a monitorable on what kind of if at all there is any regulatory change. I mean that's there on the top of mind for everybody on what as of now, there's nothing that's on the anvil, but that will remain a monitorable. But by and large, I think otherwise entities are fairly well capitalized from a risk point of view. Profitability with a slowing growth will support growth without straining on capital. Asset quality will be a monitorable across space. I mean that I put it clearly because FY25 would be a monitorable on asset quality. So as long as there are no significant deviations in terms of underwriting, focusing on the segments that one has done in the past, and no major changes in terms of portfolio level risk, those entities will fare better than entities that are looking at significant changes in those segments.
Okay. And so, how often do credit rating agencies revisit the ratings of an issuer in a year? Can the issuer request agencies to revisit? And the other one is also how does geographical diversification impact ratings?
So, from a rating point of view, we can review the rating any number of time in the year, depending on our, assessment or requirement, or basis a request from the issuer. So there are no specific timelines. There are fixed timelines. However, we do monitor entities on a quarterly basis. Most of the entities are listed, so publishing of results is a mandatory requirement now. So the numbers are available in public domain. So we do assess with data publicly with data available, and anyways we get quarterly updates from the entity. So the assessment is continuous as far as we see it. Anything intra-quarter is also looked into if there are any developments which needs a closer scrutiny. But over and above that, an issuer can request for any number of issues from a review point of view in a year. Was the other question on?
The geographical diversification, how much impact does that have on the ratings?
So there are some sectors where the rates are significantly important, especially microfinance, small business loans, etc., where a regional level impact could affect. There are other segments where it's a broader risk assessment. Any uh, uh, an issuer concentrated in an issue in a region could have impact on account of region related issues, which could be localized issues or a broader issues which could spill over to contiguous segments or contiguous regions, if I have to put it. It's a broader risk assessment, but some sectors are viewed more stringently from a geographical diversification point of view vis-a-vis others.
I think the final question is not too clear, but what are the difference between those three sectors and how ratios are determined by three different sectors? Not sure which sectors, but I think maybe he's referring to NBFC, HFC, and MFI because I think that was the slide when you were covering it. Is there any way you can differentiate the three sectors, how to analyze NBFC versus MFI versus HFC? What are the key, maybe in a nutshell? I think that would be helpful.
I think the broader assessment philosophy remains the same. The thresholds of what we look at are different. For obviously, if one were to look at a housing finance company, it's a relative assessment also. The profitability of a housing finance company could be around 2%. For an NBFC could be close to about 3%. For a microfinance company could be about 3.5-4%. Right? So one is not comparing apples to apples when one is looking at these parameters. Similarly, a leverage for a housing finance company could be slightly better, higher, right? Because the risks are lower vis-a-vis a microfinance company where the risks could pan out every 4-5 years. It's not by design, but it just happens there. So there is no reason attached to it. So leverage is expected to be lower. And NBFCs, the leverage could be somewhere in between where one is comfortable with for a similar risk assessment or for a similar rate. So, microfinance, we knew that for a very long period, the numbers where the collection efficiency was 99%, right? So, and the delinquency numbers reported were, close to about 1%. So, things have changed. So, now one is not going to compare that 1% with possibly a 2% or a 3% of a vehicle financial, or possibly a 2% of a housing loan, where the ultimate loss could be very low. So the thresholds which go into the assessments are different, while the broader philosophy remains the same. So we have thresholds across sectors, to assess, to ensure that we are looking at it on a peer-to-peer basis while assessing. And anyways, rating at the end of the day is a relative assessment of the risk profile.
Okay. Well, thank you so much, Karthik sir, for it is definitely a very insightful presentation, and I think a very great task to cover so many aspects in such a short session. So thank you so much for taking out time and so patiently resolving all of the queries which our audience has asked today. Thank you so much, sir.
Thank you. Thanks for having me. Good interacting with you and quite insightful questions. Thanks.
Thank you everyone for joining. Yes, and have a great evening. Thank you.